than 2 decades of experience in managing the fund. She's a senior fund manager with HDFC AMC. Before I loop in Roshi, I will like to tell all the audience what we are about to discuss out here. So this session will talk about economy, earnings, and equities. Obviously, when we talk about economy, earnings, and equities, definitely, though we look very short term, but the reason why we brought a fund manager of funds which are there since long to give you a proof that remaining invested is at times one of the best strategies. So before much ado, I'll request Roshi to quickly take up to the audience what is there for the economy for them to understand before we move to earnings and equities.
Sure. Thank you. And thank you for having me on the webinar today. I have a presentation that I'd like to share because I think it just sets the context for some of the longer term drivers that we all need to focus on. And I think once we set that context, then we can discuss some of the more nearer term issues. So I hope the presentation is visible.
Yes, it is visible.
So the boxes in blue highlight some of the long-term drivers that we think underpin the Indian economy. The economy over the last several decades now has been growing at a steady rate of about 6% in terms of real GDP. We think that number could accelerate a little bit going ahead, closer to 6.5. And why are we confident that even on a large base, we think that India's real GDP will continue to grow going ahead? And what are some of the drivers for that is what we've tried to summarize in the points in the boxes in blue. Which we will discuss in a little bit of detail, but just in a snapshot. I think drivers such as the manufacturing revival in India, the services-driven exports model, which will continue to add to growth, formalization of the economy, a robust banking system, recovery in private sector capex. We have seen good government capex, but we also think that we are in the middle of a recovery in private sector capex, in addition to household capex, which is largely real estate, as well as relative context from a macroeconomic perspective positions us well for our growth to continue over the next decade. But some of the things that we need to be cognizant of, and also the risks that we need to be aware of is one, we are in an environment where globally things seem to be slowing, in addition to higher leverage globally. And there's also an environment of geopolitical uncertainty, which has its impact on India as well. And valuations is something that we will also discuss. In terms of tailwinds, I think a critical tailwind for the Indian economy over the next few years is going to be the revival in manufacturing. As you can see in the chart on the left, the manufacturing contribution to India's GVA actually came down over the last decade. And I think that is something that the government intends to reverse, largely because manufacturing is a large source of employment generation, in addition to advantages such as helping lower our current account deficit. The advantage that we have in terms of improving our manufacturing footprint is that we are now extremely competitive on wages. In addition, we are also seeing government incentives in the form of PLI schemes, tax incentives, etc., and a thrust from global corporations to diversify supply chains that will help increase our manufacturing footprint. The PLI scheme is something that evokes a lot of interest among investors. And so we thought we'll just have a quick snapshot to see what is it that the PLI scheme has helped with so far. It's covered 14 sectors, and the investment that it has drawn in so far cumulatively till the end of last fiscal was about 1,23,000 crore, with some of the large beneficiaries being the pharmaceutical, automobiles, as well as the electronic sector. We've already started seeing some benefit from the increase in manufacturing footprint, especially from the electronic sector, which was one of the early beneficiaries of the PLI scheme, as well as the intent of corporations to diversify their supply chains. And you will see on the bottom chart on the left how electronics exports growth has actually moved higher over the last few years. The next catalyst is, of course, the services-driven model. While IT services growth is something that we are all aware of, and it's something that we've seen India being a big beneficiary of over the last 2 decades, I think we are also starting to see other services increasingly grow, and India's talent pool becoming a source of strength for many global companies that are looking at India for other services as well. So if you look at the chart on the left, the bars in red will show you how the contribution of other services to GDP has also been moving up. So the bars at the bottom, the IT services, and then the other services as well. We've seen a growth in the global captive centers as well as employees in these global captive centers, and in an environment where there is talent shortage in many parts of the developed world, I think India stands in good stead. The next catalyst we feel is the banking system. In order to support many of our initiatives on the manufacturing as well as the capex side, it's imperative that the banking system be in good health. And as you can see in the charts at the bottom, I think from an asset quality perspective, we are starting to see, the banking system is in very good health. And we are also, after growth bottoming during the COVID period, we are now starting to see system advances growth as well. We think that the banking system is well geared to support the private sector in their capex initiatives, as well as increasing the manufacturing footprint in the country. On the infrastructure side, I think the last few years have been a story of the government ramping up capex in various subsegments such as roads, ports, waterways, as well as urban infrastructure. And infrastructure spending, as we all know, has a multiplier effect on economy. And we think that the central government spending on infrastructure will continue to stay robust, and it will continue to improve our competitiveness as we see improvement in the infrastructure layout of the land. On private sector capex, I think this was something that in the last decade had sort of seen some sort of consolidation, and we are now starting to see improvement in private capex or a growth in private capex. I think after consolidation over the last decade, capacity utilization is now fairly high, and therefore companies have the need to invest in order to take advantage of growth. In addition, the diversification of supply chain by global corporations is also providing opportunity for Indian corporates to invest. Government supportive policies are another factor. Most importantly, the balance sheets of companies are also fairly robust. After several years of deleveraging, corporate leverage is now at one of its lowest levels, and that bodes well for private capex to pick up as well. In terms of household capex, which is largely real estate, we can see that there is a pickup in the household capex, or in other words, a pickup in the real estate cycle. We've seen, if you look at the chart on the right, we've seen a pickup both in sales as well as in new launches. Inventory levels are reasonably robust or low. Affordability is also quite healthy, and therefore we feel that the housing cycle will continue to help GDP growth. As you can see, household capex is a fairly important part of gross fixed capital formation. The chart in the middle shows you that household capex as a share of gross fixed capital formation is in excess of 40%. So that's a key driver of growth as well for India GDP. Let's just do a quick check of how India compares with other economies as well. I think the most important takeaway is really the chart on the right, which is the debt to GDP of different economies. And if you take a decadal sort of look, you will realize that India has grown without increasing leverage, whereas most other economies have taken significant leverage for growth, predominantly China. And I think that really speaks about the quality of growth which has come without compromising balance sheet. And this is to my mind, one of the key reasons why we are seeing such high global interest as well in India, um, because of relatively contained leverage levels and growth happening without having to compromise on the balance sheet. In terms of foreign flows, this is just a quick snapshot of how we've seen flows both from domestic institutions as well as foreign institutions. While the flow from the retail investors has been pretty strong, I think I must also say that only 5% of Indian household assets are currently in equities. That number in the US is in excess of 25%. Of course, it's a journey. And as part of that journey, there will be ups and downs. But the point that perhaps needs to be highlighted is that from an asset class perspective, equity still has significant room for retail investors to participate in. Of course, this is a long-term thesis, and this will not happen overnight. But the exposure of household assets to equity still has significant room to grow. In terms of some of the challenges, I think that inflation is something that, while not very pressing at this point in time, I think we have seen inflation in the developed markets come off from the highs that we saw in the last year. There are a few structural underpinnings to inflation, primary among them being just demographic changes in many developed parts of the world, China included actually, where population growth has significantly slowed, and in many countries, the growth in the working age population is actually on the decline. Secondly, greenflation, which is largely dependence on more sustainable forms of energy, that is likely to also be a source of inflation, at least initially. And realignment of supply chains in order to make them more robust and diversified will also have an initial inflationary impact. So while inflation is not a pressing concern immediately in the global world, and we are actually seeing fairly benign conditions, I think we just need to be aware that there are underlying pressures on inflation, and therefore we cannot be complacent as far as inflationary pressures are concerned. The next is higher for longer interest rate environment, which again is linked to the inflationary pressures, while of course in the near term there are signs of interest rates coming off from the highs in the past. However, I think the environment of the last decade, where we saw extremely low interest rates, is unlikely to get repeated. So I think that interest rates over the next few years will perhaps come off from current levels, but they will still be higher than the kind of levels that we saw in the last decade. And therefore, one needs to be cognizant of leverage, because higher cost of capital will impact profitability of levered companies. In addition, government deficits continue to stay fairly high, as you can see in the chart in the middle, and that is something that can also put pressure on interest rates. The point on slowing global growth and heightened leverage, we are seeing a slowdown in growth, whether it is normalization from pent-up demand in COVID, or it is the excess fiscal stimulus provided during COVID being spent. Already, I think a combination of reasons, but we are seeing slowing in global growth, and that in the midst of very high leverage levels obviously has a negative impact, and therefore we should brace for volatility in markets. Finally, on valuations, and I'm sure we will be discussing it in more detail as we go ahead, but just wanted to sort of quickly put market valuations in context of history. I think all indices, whether they are the broader index or the mid cap and the small caps, are trading at significant premium to their long period average. And we perhaps can discuss that as we go ahead. But these are some of the key macroeconomic issues that I wanted to start off with, and I will stop there. Hand it over to Abhishek. Abhishek.
Yeah, thanks. That was really quick, Roshi. So before we move to earnings, a few questions on the economy side. Look, there's a print on GDP of around 6.5%, and there are news that how people are talking about that we will continue to remain in that range. But especially on the consumption side, we have been struggling like last year. Any views on the consumption specifically? How you look way forward?
I would break down consumption largely into two broad categories. One would be luxury premium consumption, and the second would be mass consumption. Instead of just doing it staples versus discretionary, I think let's first do it as premium consumption and mass consumption. I think the drivers for premium consumption were obviously very strong because we had a robust real estate pricing cycle. We have, of course, capital markets. I don't need to mention too much, but extremely strong capital markets as well. And COVID did not impact higher end employment as much as it did self-employed and the lower end employment. And so a combination of that actually provided very strong thrust to premium consumption. And we've seen that over the last couple of years, premium consumption has been actually holding up extremely well. Now, switch to mass consumption, and the drivers are very different. The employment situation at the lower end was obviously weak. We saw a lot of self-employed also getting hit in the COVID period, obviously because the ability of the unorganized smaller segment to cope with some of these disruptions is a lot lower. In addition, I think rural economy also suffered from some monsoon vagaries, and combine all of that together, and mass consumption came under significant stress. Now, obviously, in a country like India, mass consumption is the larger part of consumption, and therefore you see overall consumer consumption growth sort of stay muted. I think that's how I will look at the drivers of consumption and break down consumption to understand why we saw the sort of weakness that we did. And that's the final outcome where, because of the hit to the larger part of the economy, which is self-employed and lower-end consumption, aggregate consumption saw softness, while premium, of course, did extremely well.
Right, right. And Roshi, what we are hearing or what we see is, in fact, the first half or Q1, the government capex was also relatively low. So, and now, as per what they have budgeted, probably next 9 months they need to spend approximately a 1 lakh crore kind of a budget. Do you see that happening? Because that is what market is sensing and what we are hearing. That's, I think people are associating that with the reason why defense and railways are relatively become an underperformer in last 15, 20 days or so. So your views on that, Roshi?
So I'll start off by saying this. I think the government has done a fair bit of heavy lifting on capex. In fact, if you look at just capital formation during COVID, post-COVID, most of it happened from the government. And private capex recovery is only a last 6 quarter story, perhaps. And therefore, in that, so now the government, of course, cannot indefinitely continue this heavy lifting on capex, because obviously government balance sheet is also an area of that needs to be considered. And I find that it's still extremely credible that the government continues to maintain its capex growth, in line with nominal growth, despite coming off such strong base. So that I would say is the broader context. I think the narrative now, or rather the heavy lifting now, has to move to private sector capex, of which we are already seeing growth. Now, as far as specific segments such as defense and railways are concerned, I think that the runway for growth is obviously very long, and we should not make decisions or conclusions basis what happens in a 1 quarter or even a 1 year time frame. As we are all aware, I think from a defense capex perspective, India continues to remain one of the larger importers, and the opportunity for greater indigenization is not a 1 year or a 2 year story. I think it's a multi-year story, and in that context, one needs to look at names. And I think that therefore it becomes important. Stock selection becomes an important driver. I think we need to look at names that can continue to be beneficiaries of that, notwithstanding the softness that we may have seen on a 1 quarter basis. The same goes for railways as well.
Now we are moving to the second section of our discussion, where I think most of our clients would like to hear from you, is the earnings part of it. I know earnings and stock performance is said to be the slave of earnings, and I think Q1 the earnings was not as per expectation. What the data has come out is almost out of 500 nifty companies, 89 companies, majority of them in the BFSI sector, did the heavy lifting, and remaining almost 400 odd companies had underperformed. So your views on earnings in Q1 and what they look forward for, Roshi?
So again, I will, I think it's easier to understand earnings by focusing on from a sectoral perspective.
Right.
I think that there are sectors such as let's say the infrastructure oriented sectors, where it is going to be stock specific, but in general, I think that the growth momentum may see some level of softening. But the bigger issue for us to track will really be margins, because after a decade of almost very poor activity on the private capex side, the last 2 years or the last 6 quarters, which saw a rebound, have also resulted in significant operating leverage. So I think the key for the infrastructure oriented companies will, of course, growth will stay robust. I think we're still in the midst of the infra or private capex upcycle, but I think it will be key for us to actually look at margin performance for different companies, given that we now have we now have a sort of very strong operating leverage, whereas growth might start to stabilize and not accelerate going forward, while cost pressures will continue to stay there. So I think it's going to be an interesting interplay as far as the infra capital goods industrial space is concerned. As far as the export oriented IT space is concerned, I think there the key is going to be revenue growth. I think that after a few quarters of softness, I think people are looking around, people are looking for an improvement in the spend environment, especially in the US. Maybe the elections will be a key determining factor. We don't know yet, but at least the indications seem to suggest that the second half should start to see some pickup in growth for the IT sector. As far as consumption is concerned, I covered that in a bit of detail. I think it's going to be a interesting dynamic between mass consumption as well as premium consumption. We are starting to see signs of growth in the mass consumption segment, driven by rural as well. So I think we should start to see improvement in those rural oriented mass consumption segments. Banking and the entire BFSI space, I think is going to be the key variable is going to be asset quality as well as the net interest margins. On asset quality, we are starting to pick up on stress in the very bottom end of the consumer segment. Microfinance is something that is seeing some pain. It's not very broad based yet. It's still restricted to low end unsecured and microfinance, but I think that will be interesting to track. we don't think it's yet a sort of widespread issue, but that's something that that will be closely monitored. And once we see interest rate cuts come through, I think the pressure on margins is also something that will be keenly monitored. I think these are some of the large sectors and some of the drivers. Overall, I think FY25 earnings growth, the absolute number of growth perhaps will be lower than the FY24 absolute number of growth, largely because it was a strong base and also because each of the sectors have their own unique dynamics as well.
In fact, does it relate to something to elections? Because a lot of companies, while they were talking about the performances, they spoke about elections as one of the key factor or impacting factor. Do you believe that? And now, since that is behind us, and hopefully we have a stable government now looking forward for 5 years, how do you see, or which all sector do you see a promising one's way forward now?
No, I think elections were perhaps a part of the reason, but there were other reasons as well for consumption. I talked about some of the reasons for exports as well. But definitely elections were also part of the reason because some activity does get curtailed during that period. The other thing, and therefore I feel that, perhaps it will be business as usual going ahead from Q2 onwards, at least for the domestic oriented sectors. But I would refrain from taking a very quarter-wise view on both stock selection and sector allocation. It's not as correlated. Just because the quarter earnings are good doesn't necessarily mean that stocks have to perform, because a lot of it may be priced in. Similarly, just because the quarter earnings disappoints doesn't necessarily mean that stocks have to disappoint, because perhaps it's already factored in. So I would say that a fair way to look at things is to take perhaps a 3-year kind of outlook at least, and then assess earnings growth in addition to valuations, and then see how stocks and sectors are positioned.
Great. So all the clients who have joined, while the discussion will continue, if you have certain questions, you can post on the chat, and all those people who have joined via YouTube, you can also post your questions during my discussion. I'll keep those questions with us and ask Roshi. Roshi, now since we are discussing earnings and you have a fair uh, guidance on this, can you break up around in some sectors which is primarily people are more worried about? You touched, if you can throw some light on infra and the real estate sector, and then obviously the banking sector, which is a very large sector to talk about. So
no, it's very difficult to sort of generalize, and I'd again say that, and that's because even in a sector like infrastructure, there are companies which are geared towards government capex. There are companies which are geared towards private capex. Now, companies which are geared to private capex can continue to do well because private capex is picked up only recently, and we are perhaps still in early phases of that cycle. Government capex, however, has been strong for the last 5 to 7 years, and therefore we could see a lot, and we, as we are seeing the pace of government capex come down, perhaps there could be some challenges on the growth front over there. So I think it's a lot more nuanced than painting all companies, even within a same sector, with the same brush. Even in BFSI, for example, what happens with banks which are primarily lending at the lower end of the pyramid versus banks which have more diversified exposures, banks which have a higher CASA mix versus banks which have a more wholesale dependence. I think there are a lot of nuances to all of that, and I would genuinely refrain from painting sectors with the same brush. Real estate, for example, it's such a localized sector. The last few years have seen a bit of a uniform uptrend, but it's likely that we will start to see a little bit of differing performance, even as far as geographic performance of real estate is concerned. So I think that after having come off such strong equity market performance in the last 3 years, it's time to be a lot more stock specific than painting sectors by the same brush. I think that easy money of just doing sector selection is perhaps behind us. I think the next few years are going to be getting the stocks right than just getting the large sector call right.
Well, I'll tell all investors because I'm not sure most of the investors are investing for long. So all those people who are listening this call, I'll just give you a quick brief to what Roshi is telling, and probably you can give a reference also. 20 years back, the fund which she is managing had an NAV which was touching almost 52. Now the NAV which we are talking about, that is HDFC Flexi Cap Fund, is at 1881. So that's almost 20 times kind of a growth which the fund has brought in. Then similarly into this I'm comparing with August 2004 and now. And similarly, if I say August 2009, which the NAV was 193, and that is almost like a 10 times kind of a growth. And 10 years back, the NAV was 438. Again, today's NAV remains state at 1881. So that's another 4.5 times. So what I'll probably try to relate things is stock selection is the key way forward. That's what the clear message is coming out from this conversation. And probably even, in fact, in each sector level, one has to dissect and find out the opportunities within that. While we continue to talk about more on the sectors, this was some of the performance which I just wanted to highlight, because at times what we have seen is people are lured with the performance of certain scripts which they hold and not looking at their entire portfolio as a whole and reflect. And because this is what I've identified when we reviewed a lot of clients' portfolio on the individual side, that overall some stocks are doing really great and phenomenally well, and but majority of the overall portfolio, when we see, at times is not even able to beat the performance of a mutual fund. And the house view remains very strongly on a flexi cap kind of an approach, where one should have a diversified portfolio, because what we have seen in the past may not repeat. That is something very static. That is very fundamental. What we want to say to all our investors. Roshi, if you can throw some light on that, because where we are seeing there's a lot of love towards certain sectors. In last 2-3 months, obviously the industry has been flooded by more money going into sectoral funds, and yes, though I'm not saying it's right or wrong, but the thought is how one should create a portfolio. If you can throw some light on it.
Clearly, it cannot be a one size fit all approach, because each of us has our unique, not just requirements and goals, but also risk appetite. And I think that's a key differentiator as well. We've seen markets only move up, and therefore it appears to us that all of us have great risk appetite and we are all willing to be long term. I think how we react when markets are volatile is perhaps the true test of our risk appetite. From a portfolio, from a asset allocation / portfolio positioning perspective, I would only say this, that the last 3 years equity markets performance cannot be the benchmark for your future asset allocation. That is something that we must keep in mind. I think the discipline of sticking to an asset allocation plan becomes even more important today than it has ever been, just because we are coming off extremely strong markets. And within a portfolio, from a portfolio positioning perspective, while again, I hate to generalize, because clearly it is a stock specific bottom-up build out, but we have seen that pockets of illiquidity have caused the most sort of expansion in valuations. And those are largely in the mid cap and small cap space. So that is something that you should be cognizant of even in your own personal portfolios. While many of them have also put in very robust fundamental performances, however, the lack of liquidity tends to amplify the extent of the fundamental outperformance, and therefore, in the event of any liquidity sort of moving out, they will take the brunt on valuations as well. So I'd say that you need to just have a thorough look at your portfolios. There are pockets of excess valuation, and one must try and minimize those, and ensure that your asset allocation decisions are not based on the last 1 year's performance, but are actually basis the last 10-15 years of performance, and make realistic assumptions when one does their asset allocation.
Definitely, that goes in for all that. That's a mantra one has to follow throughout his lifetime in terms of assessing one's own risk and see what their requirements are, what is the time frame they want to invest in for, and then creating a portfolio, looking at the kind of volatility that is acceptable to the investor. So, Roshi, few questions which I'm getting from a lot of investors is which are key sectors, though I know you said that you don't want to generalize, but key sectors where you are bullish on, or some sectors where you really wanted to participate into, because as per the current portfolio which you have in the flexi cap side, you are quite heavy on the private bank side. So that definitely seems obviously one call which you are looking forward to take. But beyond this, any sector or anything which you like to suggest?
My answer remains the same. The way we come up with sector weights is actually a very bottom-up oriented approach. It's not that we go in mind thinking that we will allocate so much to private banks, or we will allocate so much to healthcare or telecom or whatever it is. I think it is a very stock-specific approach, and the outcome is the sector selection or sector allocations that you see in the final portfolio. I would again reiterate, I think that this is the time to be extremely disciplined about your due diligence. There are pockets of opportunity across sectors. I think the one thing good about Indian markets is that it offers the scope to be diversified, because we have strong companies across different segments, whether it's consumption, whether it's exports, investment, banking, and so on and so forth. So my advice to investors is stay diversified via very high quality companies. And I would say that is genuinely the key to long-term wealth creation. The diversification at this point in time, at these valuations, is extremely critical.
So that's rightfully said. One question on sectors, as we are touching upon, not in sector specific, but in terms of market capitalization. How will you weight large cap, mid cap, and small cap in terms of exuberance, or how one should participate these three sectors if the one has to actually want to take those bets? So how one should allocate?
Sure.
Way forward.
So at this point in time, just basis valuations, the highest premium to the long-term, long period average exists in the mid-cap space. The next highest level of valuation exists in the small cap space, and then the large cap. So just basis valuation comparison with the long period average, the most expensive is mid-cap, followed by small cap, followed by large cap.
Sure, sure. Two sectors, ma'am, which are very, very popularly tracked now, apart from it, I'm not touching banks, but is the IT, and within that IT, there's a split between IT large caps and the rest, because then there's a whole lot of mid and small caps. We have seen some movement of late in the mid and small cap space. And on the pharma side, your views?
I think both sectors are very diverse. While of course it appears that the correlation between these two sectors has been fairly high, but they have very diverse drivers. Pharma is generally less sensitive to economic to the macroeconomic situation, largely because it's perhaps the last to be touched in terms of pecking order from a individual's perspective. That way, I think pharma is a lot more defensive, but pharma is also a very diversified sector in the sense that each company is very different from the other. The basket of portfolio that A company has may be very different from what B company has, and therefore, I think in pharma, being stock specific is even more important, because you might think that this company is doing well and therefore all others must do, but that company may just have a very unique portfolio. And therefore, the other thing about pharma is that it's not only about drug companies anymore. It's also about hospitals, which has very different drivers from a pharma company. You have diagnostics, you have API companies, you have contract manufacturing companies, you have so therefore there are different nuances for each of these. Obviously, a hospital company in India is going to have very different dynamics from a pharma company that is exporting to the US. And therefore, we need to be careful when we talk about just the healthcare space in general. We have exposure across the value chain. We own pharma companies, we own hospitals, we own diagnostic companies, we own API companies as well. So we are fairly diversified through stock selection. And I think that is what I would advise on the pharma sector as well. Don't paint the entire sector with the same brush. They don't have the same drivers. And on the IT sector, I think IT has had a few quarters of slowing growth because they just came off a very strong COVID pent-up spending. Not pent up, but COVID, because most of the
Valuations
stuff
were pretty
was
high. Yeah.
work from home. So that's why a lot of technology spending happened. So that sort of normalized. And now I think after a few quarters of that normalizing and some slowdown in growth, I think the view is that we could start to see some pickup in the growth, at least in the second half. But I would say that, again, we've seen strong performance in the IT sector, especially in the mid-tier IT companies. So I would just caution that please be disciplined when you look at your IT sector exposures as well. This sector has in the past also disappointed on growth, especially when you think, especially in the context of where valuations are. And therefore, I would say that please, again, adopt a very stock-specific approach to the IT sector. In general, we've seen that the mid-cap valuations are much higher than the larger cap valuations. And therefore, those mid-caps which are not able to deliver on growth are likely to, face significant disappointment.
I just move to the last leg, which is I'll take not much of time, is on the Indian equities versus the opportunities globally. Now, as we all know, China is relatively cheaper compared to India in terms of valuation, but yes, definitely they have their own challenges, and and we have FIS still coming in, not to that extent the way we used to see. Do you see this changing over a period of time? Any threats to more money flowing into India?
In the shorter term, global flows can be cyclical. And globally, money will flow wherever they think that the risk reward is best for them. But I think over the more medium to long term, I think India has the right ingredients to continue to attract foreign flows. I think, some of the charts I showed earlier was where growth in India has not come at the cost of significant balance sheet expansion, which is a good thing, which provides sustainability to growth with lower volatility and lower susceptibility to global shocks. So I think that's a very positive construct from a macroeconomic perspective, and that is obviously a huge draw for foreign investors. Now, whether all of that rebalancing happens within the next 12 months, it need not. It's possible that we may have a couple of years of slow FII investing, but if you look at it over a 10-year time frame, my view is that we will see more foreign money coming into the country from a longer term perspective, because we have the right ingredients for growth.
No, rightfully, the kind of spread which we have, I remember Navni speaking to on this in one of the forums, the kind of spread which we have in terms of stocks or sectors where we participate is not like if you talk about Taiwan, they are specific to some sector of the business, which is semiconductors and all. India is fully diverse across various sector opportunities, so definitely that's a big plus. Any early signs in terms of US elections which can derail the flow coming to India, or obviously it is somehow it is some belief that yes, Fed will be going towards some rate cuts. So how do you see in past, or what has been your experience if whenever there is a rate cut, how the Indian equities or flow from FIIs get impacted? Some lights on that.
In general, I think lower interest rates in the US is good for emerging market assets in general. But again, I would say that this is, we shouldn't generalize things too much, because obviously we've already seen very strong performance in Indian markets. But here in the theoretical construct, I think generally lower rates in the US has been a positive for emerging market assets. As far as the elections, etc., is concerned, we've not seen any significant commentary from corporates as well. I think the focus at this point is more on interest rate cuts than around, or at least the commentary from corporates is more around interest rate cuts rather than around the elections in the US.
Right. So it's really a pleasure. So all our investors who have joined, please note the two funds which Roshi manages. He manages, I think, more than these two funds itself are clubbed together more than 80,000 crores worth of AUM, which is HDFC focused fund and HDFC Flexi Cap fund. In both the funds, she manages a Flexi Cap kind of a strategy where she has the flexibility to move between large cap, mid cap, and small cap. And currently, most of you would have already heard that she is slightly overweight, or probably the construct is it is more on the large cap, then followed by small and mid, and that's how the valuations are. So thanks a lot, Roshi, and for all the customers, because I've seen a lot of questions on stocks. I'll request all the investors who wants to have a stock specific reward, please reach out to your relationship managers or our customer service, because as a fund manager, she is not. She can't speak about stocks, but definitely we can as a research house. So please reach out to your relationship manager. We'll be happy to take your questions on your stock specific queries. And thanks everyone for attending, and have a great weekend. Thank you, Roshi.
Thank you for having me.
Yeah, thank you everyone.